Today, it is time for Rapid Fire. Here to take on the headlines are Frank Holland, Deirdre Bosa, and Michael Santoli. Welcome, everybody. And our first topic, she said, is the biggest shakeup for the Dow in 7 years and certainly a sign of the times. Effective Monday, Exxon, Pfizer, and Raytheon Technologies are all out of the Dow. The new names replacing them, Salesforce, Amgen, and Honeywell. These moves also coincide with Apple's upcoming 4-for-1 split on the same day. Price being the operative word here, guys. According to Bespoke, the average share prices of the new stocks is 4 times higher, Michael, than the ones going out, because a lot has been made of Salesforce coming in and Exxon leaving. But why is Amgen replacing Pfizer?
Yeah, it's really not that much of a difference in terms of how those stocks behave. Obviously, both kind of mega caps in the healthcare sector. Arguably, Amgen a little more exposure to the faster growing parts of healthcare and biotech. But I do think it's a quirk of the Dow, obviously, that share price does actually matter, because there's an instinct not to want extremely low price stocks, because what's the point of having 1 or 2 or 3 of only 30 stocks have almost no influence on the price weighted Dow Jones Industrial Average. So They want to try to normalize that a little bit. So in addition to trying to get industry representation and some kind of exposure to the big themes in the economy, they have to worry about those mechanical issues as well.
It's interesting, guys, because Barron's makes the argument, Mr. Holland, that Facebook should go in because it's the bigger market cap, it's the better known name. Like, if they're looking for tech names, that should be one of them. But apparently, owner control over these companies is a big problem, and Salesforce doesn't really have that, but Facebook and Google do, and that keeps them from being real contenders, I guess.
Well, I mean, Kelly, here's the real question. If you're trying to improve the tech representation on the Dow, why wouldn't you include Amazon? It's because of the price weighting.
Right.
That's the issue right there. So wouldn't Amazon be very reflective of tech in America right now? Of course it would. So all these changes, they're generally cosmetic, and they're caused by a cosmetic change, Apple split. If the Dow really wanted to update and take itself into 2020, you would just add Amazon and figure out some other way to weight it.
Right. But Deirdre, as we know, that's not possible. In fact, Amazon's presence was becoming, more and more awkward because it was so out of whack with the other components. So again, it doesn't coincide with Apple's 4-for-1 split. In many ways, it complements it.
Right, and remember, this is called the Dow Industrials, not the Dow Technology Index. What surprised me more, perhaps, if you're just sort of playing this game, who could be in, who could be out, is in terms of chip makers. Intel still in, yes, but some have suggested that perhaps it should be replaced by NVIDIA. If that stock price is too high, trading above, $500 a share, maybe AMD, which is at $85 and change. So there are still lots of questions. You could play this game forever, but I personally, I like looking at the chip makers here.
Yeah, and Mike, it shouldn't be the industrials anymore.
No.
I mean, that's it. We love it for tradition's sake, but it's obviously not that. What are your thoughts, too, on kind of the founder-owner control issue in terms of who gets in?
I do think that probably is a consideration, and why perhaps it's keeping Facebook. Also, it's also a high-priced stock, so it's not too much higher than Salesforce, but presumably they don't want to do Alphabet for similar reasons as well. So I do think, it's not necessarily the case that the Dow is always going to jump on the hottest, most up-and-coming stock, to the NVIDIA point Deirdre's making. It absolutely might be the case, but there's a certain willingness of the Dow to wait until something is almost slightly past its hyper-growth phase before they jump on it. Walmart didn't get into the late 90s. It was like 30 years into dominating retail by that point.
So everyone who wants Tesla in there right now, okay, just listen to what Mike is saying and just give it a decade or so. Next up, the stay-at-home trend is leading to a surge of new tech IPOs. Cloud computing firm Snowflake. Why would you want to be called Snowflake? Anyway, they were joining a list of a half-dozen Bay Area startups filing to go public just last night. Other names include telehealth firm Amwell, workplace app Asana, and gaming developer Unity Technologies. Deirdre, we're noticing the theme here.
I couldn't believe what I was seeing yesterday, Kelly. I tweeted out 5 more, 5 S1s dropping today. Could there be another? And I was totally joking. And what do you know, 5 minutes later, another S1 drop. We're expecting Palantir any moment now. We got Ant Group, Ant Financial overnight. So this has just been the biggest boom that I can remember just in this concentrated amount of time. And what's happened, of course, markets are at record highs, but also you saw some of these names, they wanted to go earlier this year. The pandemic pushed it out a little bit. Now you see the November election kind of pushing them to right now, and you're seeing this sweet spot. But I've made the argument, there's software, such a hot play, but certainly not all S1s are equal. You take two of the most anticipated, Asana and Snowflake. One's doing a direct listing. That's Asana. Snowflake is going the traditional route. Snowflake is showing slowing pace of losses, while Asana's, doubled in the first half of this year from last year.
And Frank, to me, it's a little bit of investor beware. When a company's, kind of capitalizing on something that's super trendy, that's great. But we have to see if they have real staying power. By the way, I thought it was interesting that Jim Cramer was calling Airbnb the steal of a decade, because there's a company who would be, really hit by the pandemic that insists they're still going public this year.
Yeah, you know what? I mean, it seems like right now it's really a hot time for IPOs that focus on tech or cloud technology. But when you actually look at the numbers of 3 recent ones, you look at Rackspace, that's up 12% year to date. Lemonade, that's down 12% year to date. And ZoomInfo, that's up 8%. So it's kind of a mixed environment when you really look at it.
That's true. It's not like the surge to go public is guaranteeing performance, which, of course, we have to keep in mind. Just because it's good for the companies, but again, to your point, maybe not so much always for the investors.
And by the way, Kelly, when it comes to something like Airbnb, I do think, aside from the kind of timing of what's going on in the business, these companies that have gotten very large in the private market and have a lot of employee stock incentive compensation out there, some of that starts to expire.
Yes.
There's sort of a lot of things that are driving it that might not just be, hey, this is the perfect moment to go public.
That's true. I mean, in some ways, they all are kind of desperate, whether it's because they're the hot stock of the moment or in Airbnb's case because of the options expiring. Always something to keep in mind.